Well, we have an expert joining us who tracks the auto space very closely from IDBI Capital. Let's bring him on board. We have Bibhishan Jagtap. Hi, Bibhishan. Thanks much for talking to us on Ashok Leyland's number. Well, according to me, it looks largely an inline set. Going by the profits, which have come in at 370 crores, revenues 6,250, EBITDA at 647 crores. What do you make of it? Of course, so we saw very strong volume growth come by in the quarter gone by. Do you also agree that it's as expected?
Broadly, I think we were anticipating around 373 crore. The actual number was around 370 crore, and the consensus was estimating around 350 crore. I think the key thing to look out in this result would be how the margin has been panned out. So if you look at the numbers on year-on-year basis as well as on quarter-on-quarter basis, these numbers really not look comparable. First of all, last year we had that GST impact. So again, if you compare the numbers on year-on-year basis, this looks really good number. But nevertheless, if you look at the margins, 10.4%, it's surely a very good margin actually they have reported.
Joining us, Mithun, clearly an inline set of numbers. But, margins on a sequential basis have contracted a fair bit. RM costs, of course, have played the devil this time around. Going forward, what is the kind of trajectory that you're expecting given the high volatility in cost prices that we're looking at?
Yeah, operating performance, companies deliver very strong performance despite considering the increase in the discounting level as indicated by the management in last one or two interviews. That discount level has gone up and competitive pressure has increased. So we as well as Street estimated lower margin below 10%, though company has delivered double-digit margin. That is indicating that going forward also company is able to mitigate the pricing pressure related to the raw material price hike by passing on the increase in the cost inflation.
Hi Mithil, this is Nayantara joining in. So if the company surprised you on the margin front and is done better than what you were penciling in, plus the fact that prospects are improving for commercial vehicles now given the change in norms as far as the axle load goes, how are you going to re-rate the stock if you're going to do that?
So there is no clarification whether it is only for the new vehicles or it is also for the existing vehicle. Right now, if we assume it is only for the new vehicles, so it is momentarily positive. There would be definitely impact to the tune of 15 to 20% on the volume of the industry for the MHCV particularly. But if it is given this benefit to the existing fleets also, then there would be a sizable impact. Though we believe that not all the vehicles will be able to get the benefit, will be able to implement the benefit on the vehicles. We assume roughly last 10 years vehicle to the tune of roughly 2.2 million units is the overall size of the population which would get this benefit. Out of this, if we assume there would be already unorganized player using this overloading on a frequent basis, then organized players, that numbers is on the back of annual calculation comes to roughly 1 million units would get this benefit of 20 to 25%. So that is nearly equivalent to 200 to 250,000 units. So yes, if it is given on the existing fleets, those benefit, there will be a sizable impact. Though we believe that government may not give this blanket permission, there would be a number of changes required for that number of.
Correct. But let's just stay with the numbers that have been announced. Bibhishan, if I could come to you now, it's a very strong quarterly performance from Ashok Leyland and is being rewarded on the Lal Street as well. The stock at the day's highs, it's higher by about 5.5%. It's a beat on the operational performance clearly and the ability shown by the company to pass on the pricing to consumers as well. Will you re-rate the stock?
So I think we have a target price of around 178 rupees. Our volume growth is about 13 to 14%. We believe that industry would continue to grow well, and we have factored in all these growth prospects in our target price. So we do not see any further increase or re-rating in our target price.
Ishan, given that there are so many, regulatory norms and so much transition ahead of CV players, given that there's scrappage policy and now there's an axle load hike, transition to BS6. Going forward, given all these dynamic changes that are taking place in the industry, do you believe a CV player as Ashok Leyland will be able to sustain this high demand trajectory, high, top line growth?
Yeah, so I think as far as macroeconomic factors are concerned, we anticipate about 13 to 14% of the growth, and we believe that Ashok Leyland will continue to do well even in FY19 and FY20 as well. Right, that is number one. As far as capacity is concerned, I think they have a pretty much capacity to fulfill the respective demand. The only factor which we need to really look at the how the discounting will pan out and how the raw material prices would be going ahead. So I think for this quarter, company has taken about 2% price hike just to offset the raw material prices. But overall, I think Ashok Leyland has the capability to fulfill the demand in the market.
Right. So yeah, clearly the discounting and pricing trends and the RM cost is something to monitor going forward in terms of how the pricing will play out, how the demand will play out. Thanks both of you, Mithul as well as Bibhishan, for joining us for fast cut reactions on Ashok.